Have you ever wondered why your money goes further or less than expected? Do you feel like there are invisible forces pulling the strings of your personal finances? Get ready to uncover the hidden strategies governments employ to shape the economic destiny of their nations, and therefore yours. This isn't a conspiracy. It's the harsh reality of economic geopolitics. Governments aren't mere spectators, they're active players on the grand global economic stage. Their economic policy decisions define the course of a country, directly impacting your purchasing power and opportunities. These policies can be oriented toward internal or external development. Inward-looking strategies seek to strengthen the domestic market, promoting national production and domestic consumption. This can create local jobs and reduce dependence on foreign goods, but sometimes at the expense of global competitiveness. On the other hand, outward-looking strategies prioritize the development of external markets, boosting exports and integration into global value chains. This can bring in foreign currency and technology, but it also exposes the economy to external shocks. The choice between these two paths is not trivial. It is a statement of economic and social principles. An internal approach can protect nascent industries, while an external approach seeks efficiency and specialization. Both have their supporters and detractors, and their consequences are felt in every home. Imagine your country's currency as a powerful tool, capable of altering the value of everything you buy and sell. Some countries, subtly or blatantly, manipulate their exchange rates to gain competitive advantages. A weaker currency, for example, makes imported goods more expensive, making it difficult for foreign companies to compete with domestic ones. This artificial devaluation makes your vacations abroad more expensive and increases the price of imported goods. However, it also lowers the cost of the country's exports, boosting local industry and creating jobs. It's a double-edged sword that can protect domestic producers, but at the same time erode citizens' purchasing power. The debate over currency manipulation is intense. While some see it as a legitimate tool to protect the economy, others denounce it as an unfair practice that distorts global trade. Understanding this mechanism is crucial for any conscious investor or consumer. Who said the market is always free and self-regulating? Some governments don't hesitate to inject state funds directly into financial markets. They do this through government-controlled banks or large public companies, purchasing strategic stocks or bonds. The goal is to boost enthusiasm and generate an artificial circle of trust. This intervention may seem like a shot in the arm, but it's often a way to direct capital toward specific sectors or to support companies that would otherwise not be viable. While it can stabilize failing markets or boost strategic industries, it can also distort prices and create bubbles. Investors should be aware that not all market growth is organic. This practice raises serious questions about market fairness and efficiency. Is it fair for the state to compete with private investors? What happens when state support is withdrawn? Intervention can be a lifeline, but it can also be a crutch that prevents true economic adaptation. Dependence on the export of a few raw materials is a recipe for economic vulnerability. Countries that base their economies on oil, copper, or specific agricultural products are at the mercy of volatile international prices and investment cycles. A drop in the price of your main export can trigger a national crisis. Economic diversification is the smart strategy for building resilience. This involves expanding sources of income by promoting manufacturing, services, technology, and innovation. This often requires bold tax reforms that incentivize new industries and attract foreign investment. A diversified country is less susceptible to external shocks and offers more job and business opportunities to its citizens. It is a long-term commitment to stability and progress, moving away from the roller coaster of commodity markets. Education and investment in human capital are fundamental pillars of this transformation. Following the end of World War II, the world embarked on an era of reconstruction and development. However, development strategies did not emerge in a vacuum. They often followed the guidelines set by industrialized countries. The existence of a single development model applicable to all, the capitalist model, was assumed. This hegemonic vision, promoted by international institutions, dictated economic policies for many developing nations. While it brought progress on some fronts, it also drew criticism for ignoring the cultural, social, and economic specificities of each country. The imposition of a single model has often led to dependency and deepening inequalities. It is crucial to critically analyze these models and their consequences. Is there really a single path to progress? Or should we seek more tailored and sovereign solutions? This debate remains central to understanding global economic disparities and the pursuit of more equitable development. Inflation is the silent tax that erodes your purchasing power. Keeping it under control is a priority for any responsible government, and exchange rate stability plays a crucial role in achieving this. A stable exchange rate allows businesses to plan their prices and wages with greater certainty, reducing economic uncertainty. When the exchange rate is volatile, import costs fluctuate, resulting in unstable prices for consumers. This is where the central bank comes into play, using monetary policy to keep inflation in check. Raising or lowering interest rates, or intervening in the foreign exchange market, are some of their tools. Uncontrolled inflation can devastate savings, reduce the value of wages, and discourage investment. On the contrary, moderate and predictable inflation fosters confidence and enables sustainable economic growth. Understanding how to combat this specter is essential to protecting your assets. Economic growth is the engine of progress, but how is it achieved? There are two main approaches. One sees growth as a matter of managing domestic aggregate demand, that is, stimulating consumption and investment within the country. This can be achieved through expansionary fiscal policies or by lowering interest rates. The other approach prioritizes exports and competitiveness. It seeks to produce goods and services that can be sold in international markets, generating foreign currency and economies of scale. This involves investing in infrastructure, technology, and education to improve productivity. Both paths have their advantages and challenges. Growth driven by domestic demand may be more inclusive, but it risks generating inflation or fiscal deficits. Export-led growth may be more efficient, but it exposes the economy to global volatility. The key is to find a balance that suits each nation's circumstances, seeking robust and sustainable development. In a globalized world, the temptation of protectionism remains strong. Some countries implement non-tariff barriers, such as complex technical regulations or import quotas, to hinder the entry of foreign products. In addition, they provide subsidies to their domestic companies, allowing them to compete at lower prices. These measures seek to protect local industries from foreign competition, safeguard jobs, and promote domestic production. However, they often result in higher prices for consumers, less product variety, and reduced efficiency for protected firms. They can also provoke trade retaliation from other countries, escalating into trade wars. Protectionism is a topic of constant debate. Is it a necessary tool for economic sovereignty, or an obstacle to free trade and innovation? Understanding its implications is vital for any citizen who wishes to understand the forces shaping global trade and its impact on everyday life. We've revealed some of the most influential strategies countries use to manipulate the economy. From development policies to market intervention, every government decision resonates in your pocket. Economic manipulation isn't inherently good or bad. Their effectiveness and consequences depend on the context and how policies are implemented. Now that you know the hidden rules of this game, you have the power to be a more informed and critical player. Don't sit on the sidelines. We invite you to delve deeper into these topics, to question official narratives, and to demand transparency from your leaders. Share this knowledge with your friends and family. Discuss it in your circles, and above all, make informed financial decisions. Your financial future depends on your understanding of this complex landscape. Don't let them manipulate your pocket without you knowing.